Hello, everyone. My name is Dominique, and I am here with the rest of the Greenleaf team here with us today. We have our hosts, Dave and Andrew, and driving this live stream, we have Natalie. So again, folks, like we mentioned previously, we are going to dive into our retail sector and provide a market review and market update, specifically what we saw throughout last quarter for Q 2021. So before we start here, we would like to provide you with some reminders that this live stream is recorded and will be shared with you by the end of the week this week. We do encourage you to submit any questions. This live stream is a little bit different than our regular scheduled programs like our deal announcements and updates and things. This is really geared to answer any questions that you may have operationally, financially, regarding any of the investments that you have here today with us. So if anything pops up as our hosts go over our portfolio, please feel free to use the Q&A feature located at the bottom of your screen to submit any questions, and our team will be sure to answer them. All right, without further ado, I will pass it over to our hosts, Dave and Andrew. Thanks, everyone.
Thanks, Dominique.
All right, thanks, Dominique. Thanks for everyone joining us today. We're excited to go through our retail update. Have a lot of exciting things that happen in the fourth quarter. I'm gonna jump right in with the sales and the acquisition part. We've got 12. Sure. We have 12 total right now. Assets.
12, yeah, 12 since inception.
Since inception.
Yes.
So acquisitions and sales front. So O'Charley's is ending their due diligence.
Right, and we went under contract. I think it was late November, December. Buyer is a developer. Not looking, 50-50 right now, whether it goes through or not, but likely Charlie's is we're going to see this one goes through, and then if it doesn't go through, we'll go for a plan B. O'Charley's is our it's in our shortest lease right now. I think it's our shortest lease.
Probably shortest left, like 2 years left.
It's about I think it's three and a half years left right now.
So lots of time.
So right, either a lease extension or what's next for O'Charley's. We're looking at that right now.
Yeah. On the acquisition side, we have 3 deals that are under contract too, going forward.
It was a rough December.
Yeah,
rough December.
We're gonna Applebee's and Seneca, Taco John's, Princeton, Kentucky, and Family Dollar. That was in Decatur. That was our first Family Dollar we bought, and first Taco John's that we purchased.
And the first time we ever closed 3 deals in basically a month. Family Dollar had to push the first few days of January, but literally we had 3 deals closing in a month, which was a record for the retail team at least.
Yeah, it's exciting.
Yeah.
On the operating side, we are focusing mostly on our lease term management right now. So when we talk about like how much term do we have left on a lease, and is there an option, even if they're 3-4 years out, can we go get an extension on that lease? Can we go renew that lease? We had a lot of success with that on our Applebee's in Duluth, which we have since exited, but that was during COVID. We got a lease extension. We took it from 7 to 13 years. To really add value in that deal.
Yes.
And we're looking at, hey, are there other deals that we can look at our current leases with and find a way to extend those now as well? Talk about our performance versus same stores. We're always trying to find out.
Right, and we're always trying to buy we're trying to buy the Dollar General or the Applebee's that outperforms everything. So right now, when your favorite topic placer, when we look at our foot traffic data, we're always trying to buy properties that are in that top third quadrant of foot traffic when it comes to same store comparison. So we want to make sure we're buying the top quadrant Applebee's, this top quadrant Dollar General, the top dollar Family Dollar. Oh, I forgot to tell you a little Family Dollar news. I talked to the neighbor in Family Dollar today, and he said, "Oh yeah, your Family Dollar is kicking it." So evidently that Family Dollar is
he thinks it's good. Right.
It's known to be doing really well. And so that was just affirmation of our purchase from a completely independent source who actually sold it to the guy who sold it to us. And he still owns the plaza behind it. So that was really good news about Family Dollar. Too.
Yeah. The other part is just cap rate compression as a whole. We're seeing that across all of the brands that are out there. Well, we're seeing that across all of the strong performing brands that are out there. So that's kind of a look at like acquisitions and updates. When we think about where rates are going, we've got this graphic here. There's $90 billion in net lease transactions in 2021. And of that, there was some initial 2021 concerns around this, like, are they going to continue the 1031 tax code? Like, what changes are happening? They did not end that. Some people are on that will never end, and others are, well, pieces of it will change. we thought those two factors combined, the influx of cash and that we saw the national average of cap rates was 5.8%.
And don't forget low interest rates too. So low interest rates will always drive cap rates lower
Yeah.
too.
So this is just kind of like where things are at. We are not buying things at 5.8% cap rates.
No, we
That
can't.
is not, that's not the field that we are playing in. So we're buying everything above that average.
Right. We're focusing on the high sixes, low sevens right now. Anything with the 7 in front of it, we look at pretty hard right now, including it's any property, industrial. Yeah.
Yeah,
office.
across all of our asset classes, if
Yeah.
it's starting there at a 7 and we can take it higher than that, we're definitely looking
Yeah.
at those.
Well, if you look
So
at a pyramid, we're always looking at the top of the pyramid. So the top of the top little triangle of the deals, those are the deals we're always
Yeah.
focusing on. And hopefully we're good enough to find that top triangle of the
yeah, we've
pyramid.
got we found 3 of them in December. So.
We did.
So the brands that we're working with that we know have compressed, we look at Dollar General, and on average, because we're tracking every Dollar General that sells, whether we bid on it or don't bid on it, whether we buy it or not, that part doesn't matter from a market standpoint. We've looked at all the transactions that have sold along with Family Dollar. And as we can go back and aggregate this information and get it, it's very, very readily available. But we're seeing definitive cap rate compression across these brands. And then Applebee's.
And Dave, what does cap rate compression mean as it
That
relates
means
to a price?
values are going up and that means yields are going down.
Yep.
So-
So it's not fun for us because it makes it harder
makes
for us
it-
to buy.
It does make it harder to buy it, but it makes the outliers more easy to identify,
And it makes what we own currently
worth more.
worth more. Yes.
Other part that not only on the cap rate compression, but just a store performance, Applebee's, which we just recently, closed another one here in Seneca. Their 2021 sales have surged over not only 2020 COVID, and there's a drop during COVID, but 2019 as well. We're starting to see on the reports coming out from the stores that they have a lot of the curbside pickup activity happening.
And our Lithia Springs Applebee's is closing we're still in January next month, and that Applebee's is kicking butt right now.
No, like 30%, 35% curbside pickup.
I think it was like 30 to 35% of their business now goes out the side door, which didn't happen in 2019.
Correct. Yeah.
Yes.
That's all new. So when you see brands that are adapting and trying to figure out, hey, how does our business evolve over the times, whatever curveball's thrown at it, we're going to adapt to that and move forwards. Applebee's has certainly done that. So that's exciting. That's exciting to see from our position because we know we have a brand that wants to grow and wants to solve problems and figure things out.
Right. And I think you also made a comment about professional operators and people who know how to deal with swings of the market. So they know how to hire managers, they know how to hire staff, they know how to deal with difficulties. A mom and pop bar, a mom and pop restaurant may have a little bit more difficulty operating in this type of a difficult environment, and they might not be capitalized to do this. They might not have the capital
Certainly.
to be able to survive this kind of time. But Applebee's, Neighborhood Restaurant Partners, all of these big, large franchises have that ability. This is your favorite graph.
I do like this chart.
Yes.
We look at our occupancy quarter over quarter, and this is something we do across all of our asset classes. These look pretty good though. So, everything here, we've had no occupancy changes. Everything is level across all of the assets that we have from Q3 to Q4.
Basically, you just wanted to make a chart with all the properties at 100%. Is that what
Yeah,
this is?
chart. I think charts with lots of green on them are positive.
Okay, yes, I agree with you.
And
This is
when
a
the
great
numbers are
chart.
real. So all this, we didn't just make it green for the sake of being
Great
green.
chart. You're right. Oh, and look, another one too.
More green.
Yes.
So cash positions. We sent out all of our distributions on the 20th of January, and you received all your quarterly reports. Those went into the Juniper portal on January 20th as well. And going forward, the 20th day after the end of the quarter, that's when we're going to send everything going forward. So have a consistent distribution timeline. When we do that, anything that has a reserve balance over 100%, that's what's being distributed.
Right. And every single retail property except Grapes and Grains right now, but we've paid everything on our preferred return. So everybody is caught up. Every single property has at least paid prefs and some of the paid profits too.
Yep. And Grapes and Grains, we see our reserve balance here. This one came out of construction. Our tenant is in there and operating, but we do not have our full reserve balance there. and they're not paying rent until June. So we're not really going to earn any more cash until June. All right, and then opportunities of what's coming up
Yeah.
for 2022.
This is exciting. So tomorrow we have a meeting internally at Greenleaf to talk about this with some staff, but we're talking about a couple of new things, which I'm very excited about. Number one, we're expanding our footprint to 2 more states. So we're going to Texas and Florida for our retail deals, our triple net deals, our loan management part of the business. And we're also,
But that expands our access to population. We're always, we're always going after population growth. So in the current market in the Southeast that we're in, we're at 30 million people. If we include Texas and Florida, that takes us to 80 million people.
so we've just doubled our population size. And then I didn't even think about this, but we're also expanding our brand competency. So now we have competency in other brands, which is amazing. So, when we're buying a new brand, a Family Dollar, we don't just buy a piece of property that happens to be called a Family Dollar. For every single brand we buy, we do a very, very deep dive into the actual brand to see how it's doing, how it's performing, what their cash is on hand. Are they a growing brand? Are they a declining brand? So we do all this analysis when we buy a piece of property.
And same with the Taco John's we spent a lot of time, and you definitely did, with the operators of that and their business. They own 12 other locations.
Yes, we definitely.
And they're looking at growing more and doing more. So that partnership goes well beyond just, hey, let's just look at a piece of property and buy that. It's who's there, who's running the show, and how do we talk with them?
We definitely asked the Taco John's operator too many questions, but he was patient with us and we did it. And we have a great we have a great new partner. And then the next thing we're really excited about is we're talking about how do we get involved with the operators of these businesses? So how do we get involved with the franchisees, the franchisors, the operators, and the builders of these major brands to starting partnerships with them, and then helping them either build or exit or partner with them to get these major brands into the marketplace, or I guess if they want to sell them. So if they actually build one and sell it, we could be a candidate to actually buy. Some of
just
these deals.
participating in additional parts of the value chain, the retail segment with the operators.
And so honestly, we're not paying 5.85, buying the deal at a 5.85 cap. We have a partnership with a builder. We can get it for a little bit better price.
Okay, so that's what we're looking at for 2022. We do want to open it up to questions on any of the deals that we have, and hopefully answer any of those for you at this time.
Okay, our first question is a refinance question. Do you have any upcoming refinances for retail?
Retail, we have one, not necessarily a refinance, but a loan modification. So I'm currently working on a loan modification for the O'Charlie's loan. I believe our current O'Charlie's loan right now is in the 5s. And I'm talking to the bank literally. And the first offer they gave us is to actually lower the rate by about 0.6% from 5.4 to 4.8, which is great. And that was literally just a question.
And that was a request. We're not going through a full refi cost structure. It was more,
it'll be
let's modify this down if we can.
It'll be a 1-page loan modification, and it'll be very easy, very low cost, and a direct impact to our bottom line for Fund One.
Excellent.
And this would be our second one, because we did our loan modification on Zaxby's also, and also got a nice little modification of the loan too.
I think that's the only one though on a refinance discussion, right?
Nothing else is up for refinance. Correct.
Okay, we have a sales question for you. Do you have any planned or potential sales this year?
We do. Right now, we are looking at, as we promised our investors last March, we're looking at an exit of our Whiskey Road property after a year. March will be about a year. And so I'm currently working with the tenants of the strip mall to try to get some lease extensions out of it. And then once we get the lease extensions, we would put it up for sale and look at selling the strip mall first. And then, of course, the value of this deal is the Panera. And then once we have some idea what's going to happen with the strip mall, then we have to figure out what we're doing at the Panera. We could keep it, we could sell it, but there is a ton of value right now in the Panera, and the Panera will be very, very easy to sell.
Yeah, so that was one we purchased, and it came. There's a Panera next to a strip, a
3-tenant strip mall
that has like Aspen Dental that's in there. So we've got a strip mall next to a Panera. And originally going in, we knew we hit a year. We've held it for our long-term capital gains rate, and we're going to look to split those apart because they're worth more separate than they are combined.
And Panera's, would sell for a cap rate in the 4s or 5s versus a strip mall, which would sell for a cap rate probably in the 6s. So definitely the Panera is worth more.
We have a few operational questions. So first, can you provide us with an update on grapes and grains, including distribution plans?
Yeah, so grapes and grain, we got our CO on grapes and grain on December 31st. So we snuck that one in right at the last minute of 2021. Couldn't have been any later. And what that does for us is it kicks off when grapes and grain, the tenant there will start paying rent, which will be in June as part of their lease agreement. So they're open and operating and doing really well, but we do not have rent until the June timeframe. And then at that point, we have to build some of our reserves up on the lease structure. And then from there, we will distribute. So that's probably looking at going into the third quarter before we make continued distributions there.
Our next question is on Edgewood. How is this asset doing?
Oh, that was our 2020 excitement.
That was our
From Edgewood.
2020 big lemons to lemonade very quickly. So Edgewood's doing great. Just to review, we went from $12,000 a month rent to $16,000 a month went with our new tenant. Tenant loves us. Our tenant is great.
And his sales are better, doing better than expected right now.
He
too.
told me, like, Andrew, I didn't expect to be doing this well. He actually told me that, which was really surprising because he would usually want to talk his success down in case he, but he said, I'm doing great. And, we have an opportunity right now to buy a piece of land next to it, which we're working on, which would actually help with parking at that location and be able to generate additional rent. So working on that, just talked to the seller of that, or the broker of that land a couple of days ago, and they're working on what a sale would look like. So that may come. And then the biggest problem down there at Edgewood is that you can't park your car. And so if we have that great property with great parking.
But it's also very much like a happening place that not everyone is able to, there's not parking for everyone. There's no parking decks really around that neighborhood. So it's all street. All the buildings are, 70, 80 years old or older. Right. So they weren't really built for like, hey, let's have a bunch of bars and restaurants and stuff there, but that's what makes that area exciting.
Yes. It's a very exciting place for.
But if we can pick up some extra parking, it's definitely a value.
Yes.
So we're looking at that pretty aggressively to see what we can do there.
Okay, we have a placer question for you.
Oh.
After purchasing a retail or triple net property, do you track placer metrics to see if a property continues to perform as expected over time, or does the tenant provide performance metrics?
Well, I would say the tenant isn't really proactively providing any performance metrics.
Right. Some of the tenants do, like Zaxby's and the DQ. We get sales.
We'll get sales reports, but not like more proactive. Like, hey, here's really how we're doing, and like a write up of their feelings about it. Yeah. But we can tell from Placer every time we're looking at a brand and other brand locations, we're looking at what are the ones we have and what is the market of them doing. So we can pull up a Family Dollar and pull up all of the Family Dollars in the immediate area, see how they compare to one another, and make sure that we are still trending on the higher end of everything. So we're definitely looking at that part on an ongoing basis.
Right. And with the Whiskey Road property, literally, I just sent in the Whiskey Road addresses for verification of Placer right now to make sure we have the correct Placer data, so we know how those three strip mall tenants are performing in reference to the other brands. So, is it performing better than all the other? Is Aspen performing well? Is the Vitamin Shop performing well? And is the Mattress Firm comparatively performing well?
When we use Placer in a strip center, like where we have 3 or 4 tenants in one place, that's a little bit hard because you can't really tell like what store exactly did they go to, because it's tracking your cell phone. So you can try and do that a little bit, but we're looking at more from like, do they go to that property, and that property is performing well. It makes it a lot easier when we have a single tenant net lease, because not many people will go to the Family Dollar parking lot and go somewhere else, right? Like they drive to Family Dollar, you're probably going to Family Dollar, along with all of our restaurants that are the standalone net lease buildings. So it works very well on those fronts.
Yep.
Our last submitted question is, what additional brands are you looking to possibly purchase this year?
It's a good question. There's probably, usually there's a threshold. So we're looking at brands greater than 50 units. We're focusing on fast food, QSR. So anything with a drive-through, first of all, focusing on growth brands, businesses that have growth in mind. So like, for example, Taco John's, Goldman Sachs just bought Zaxby's. And so Goldman Sachs wants to blow up Zaxby's right now. And so we're focusing on those brands. We're also focusing on our dollar stores. Every Dollar Tree, Family Dollar, Dollar General, all have pretty aggressive growth plans. And so, it's generally any major brand, something you'd recognize. that's growing, but then also there's others that are not necessarily recognizable, but they're growing. So like they're brands with 20 or 30 or 40 units that are building a unit every 6 months. What is called Salata.
Yep.
Like-
There are a bunch of those around here that other
Yeah.
people might not know about them,
Right.
but they're here.
And Lazy Dog,
Going.
Lazy Dog right down the street is,
Lazy Dog is a very large footprint sports bar, casual restaurant that's here in Atlanta, and I think they have 25 locations or 20
yeah,
locations.
and it's a huge footprint, and
It's like an 8,000 square foot footprint, which
And
is substantial.
one thing I love about Lazy Dog is you go there, you eat dinner, and then you order something from their to-go menu, and you take home something called a TV dinner, and you get to actually take home additional food that's frozen in like a little container,
Yeah.
and then you like have it for dinner the next night. So I think that was
Yeah,
pretty awesome.
it's a neat restaurant concept. There's probably one a mile from our office here, so we've been to it a couple times.
Yeah.
We have one more question come through on Edgewood. So if you purchase the lot next to Edgewood, do you renegotiate the lease terms or rent with the tenant?
What we'd actually do is we would rent the lot to the tenant. And the initial discussion was that that lot would rent for about $3,000 to $3,500 a month. And so the tenant would basically go from about a $16,000 rent. So with the additional property would go to maybe a $19,000 to $20,000 a month rent because of the extra lot. But there'd also be an extra cost involved in purchasing the lot, but that would be the current plan.
Those are all the questions that we had come through.
Okay.
Thank you.
All right.
Natalie.
Yeah. Thank you,
Dominique.
everyone.
Thank you so much, everybody, for joining our 4Q 2021 quarterly reviews for our commercial, retail, industrial, and multifamily portfolio. We certainly do appreciate you joining us today, and we look forward to seeing you soon. Have a great day.
Before you log off, we had one more.
Oh, we got one that
Lot.
snuck
Question,
in.
once I snuck one in.
So would the extra lot for Edgewood be another triple net deal?
We would lump that in with the Edgewood deal to start with from there.
Yeah.
So
And
it would start there, and that's kind of like that first right of refusal to the people that are involved in that deal. Like, hey, do you guys want to participate in this? It's right next door. It's the same thing. And if that doesn't work, or there's mixed interest, we would take it out after that.
honestly, for the price, it would be like buying like a, kind of maybe a middle class or $400,000 house and then renting out a $400,000 house, if you want to think about it that way. So it would be a small addition to the Edgewood property.
It would make a lot more sense to do it.
Do it together,
yeah.
right, with same investors, yeah. Inside, this is also in Fund One, so it would be inside the Fund One pool.
Now that's it.
Okay.
Okay. All righty. Well, thank you very much, everyone.